There have been several yield curve inversions in this cycle. The most important one so far has set off a chain reaction within the financial industry. Many investors are starting to wonder if this is the recession signal they've been waiting for. We've watched countless indicators and their progress over the years, but it's not until the Fed begins to react that investors will dump. So the strategy is pretend everything is great to try and calm the markets while everything deteriorates. You came here for the truth, so let me unveil that for you. The yield curve inversions are something I have been covering obviously for quite some time. We're seeing them happen. There isn't just one yield curve inversion, of course. We have seen many. Some seem to be more important than others, but ultimately we can say that when this happens, it tells us that the cycle is near complete. It is actually when the yield curve starts to reverse, and then we generally see a recession that follows. This has led to some increasing panic in the markets, and I want to talk about that today. On Friday's trading session, we saw the US stock markets falling into the red quite significantly. That continued on to Monday's trading session for the Asian stock markets and now has again started to become a little issue for those in the US. Now, it's not as bad as it was on Friday, clearly, but the negative sentiment is still there. So they need some positivity. Maybe it's going to come from the Federal Reserve, or maybe it'll come from a former Fed chair, Janet Yellen. We'll talk about that more in a moment. Take a look at Apple stock right now. You can see that it has fallen below its 200-day moving average. What's interesting about this is that as I record this video, they have a presentation on right now. They introduced a new TV streaming service, something similar to a Netflix. They also have a credit card, which they have just introduced, partnered up with Goldman Sachs, I believe, and a few other things. I believe the concern may be related to the fact that this sort of admits that they're suffering on their hardware. Maybe there's more competition. Maybe the prices are too high. You can judge that for yourself. Regardless, it kind of shows that hardware isn't the future of Apple, and so they need to open up a new stream of revenue. That's what they're trying to do here. We'll see how it goes. Ultimately, investors in the short term probably didn't like this, but in the long term, if they start to bring in some good numbers, then investors will see that and perhaps the stock will rise as a result. Once again, Janet Yellen is shaking it up in the news. Former Fed Chair Yellen says that a recession indicator in the bond market, we're talking about the yield curve, could mean a rate cut, not a downturn. That's right, you heard it here first from Janet. I would vote for negative interest rates if I could. Yellen said this. My own answer is no. I don't see it as a recession signal. There she is trying to calm the markets, making sure everything is just fine. In contrast to times past, there's a tendency now for the yield curve to be very flat, saying, don't worry about it. I mean, it's generally a lot flatter than it was before. So if it inverts today, there isn't a reason to worry. Just keep putting more money into the stock market. You can trust us. And in fact, it might signal that the Fed would at some point need to cut rates, but it certainly doesn't signal that this is a set of developments that would necessarily cause a recession. So let's see, 7 out of 7 times it has caused a recession. Here we are, 2019, and Janet Yellen says this isn't going to cause a recession. But let me be very clear. The fact that the yield curve inverted didn't cause a recession in the previous cycles. It just warns that this is happening, that we are approaching the end of the cycle. That's the whole point. And I know that Janet Yellen knows that, but of course this is what they are obviously being paid to do, or they're so naive, but honestly I cannot believe that. Somebody who is clearly very powerful, very much in the know, at least at this level, is obviously going to be aware of all of this information. She's read the history. She knows exactly what's going on. And here she is again shaking it up in the news. Well, let's go to contrast with some other information that I wanted to show you. Morgan Stanley, get defensive because the inverted yield curve is sending a message. This is not coming from me. This is from Morgan Stanley. Investors should remain defensively positioned on stocks. That's according to Morgan Stanley. Part of the closely watched yield curve inverted on Friday, a key indicator of an economic recession. At the bottom, we think the ending of quantitative tightening is a rate cut and a Fed that is cutting its bearish view of stocks. Now you have to understand for a second what Morgan Stanley is talking about is basically what we've been tracking here for the last little while. It's very hard for the Federal Reserve to accomplish what they need to with their forward guidance by acknowledging to the public that they're going to take care of everything, but at the same time not making it seem like things are bad and that they need to react. But it's a difficult juggling that they need to constantly be doing in order to maintain strength, but at the same time ensure security for the markets. Right in the second paragraph, they mentioned something. Following the announcement referring to the stimulus measures and the quantitative tightening, Wilson said that the central bank did not get the reaction they expected as the yield curve immediately inverted. And then towards the bottom, before the Fed's announcement, it seemed unlikely that the central bank would have a more dovish policy message. However, that's exactly what they did when they effectively telegraphed with their dot plot there would be no more rate hikes this year and provided guidance that they would end the balance sheet reduction in September. All things I've covered before, so let me go on with this. This top paragraph is extremely important, then we're going to move on. An inverted curve has implications for stocks, particularly given the fact that we are now full on valuation. In our view, lower rates are only good to a point because eventually the fall in rates is not just about the Fed giving equity investors a green light to risk up, but it's also about slowing growth. It's a real balancing act. They can't bring down rates without signaling that they are actually receptive to negativity in the markets, as well as they can't increase rates because they don't want to slow things down. So they're watching everything deteriorate all around them, and yet they can't really react, and that's why they're usually too late to the party. They always bring rates down way after everything is coming down. The public isn't aware. They're asking, why aren't you doing this? Why aren't you doing that? Well, of course, they're being pulled from all sides. This is not a simple task. And of course, that's why there should be no single institution that does this, but that's a whole different story. 10-year Treasury yield falls to the lowest since December 2017 on global growth concerns. This just came out. I wanted to add it in here. As you can see, this continues to fall further and further as time goes on. Comparing these U.S. Treasury yields, you can see the green, which is the 3-month, crossing over everything as all of these begin to invert. It's not a good sign when this happens, of course. The only question is how long? How long? People want to know when. You're never going to know when. That's why Morgan Stanley was basically saying you need to get defensive with your stocks. That's why money should be moving out of growth stocks and into more secure ones. That's what they suggest. Here's another. This is the 1 month, 2 year spread, just showing you an inversion as well. They all seem to be doing this. You know something is completely messed up when you have $10 trillion worth of negative yielding debt. So while most people know that yes, in fact, you can buy a bond for Germany, for example, and get a negative yield, negative return, but they're generally unaware of the fact that there's $10 trillion worth of this stuff hanging out there. And just since the crash began in September, October, we have seen it almost double. You could see where it falls out at the bottom here. I'll bring out the highlighter. It looks like not quite $6 trillion, and now it is over $10 trillion just in the last few months. So that tells me that investors are more likely to buy an investment, fixed income, a negative return on their money instead of buying Apple stock, for example. That to me is very telling. But if you're not connecting the dots together, you're never going to see the picture. And I just want to thank Bank of America for this quote. It's fantastic. Stock gains solely driven by corporate buybacks, derivative call buying, short covering, retail single stock buying. In April, things are going to change for that short period of time. I want to see what happens after that, but at least for April, we're in for a very interesting month. I'm going to cover it here on the channel. Make sure you subscribe if you found this video informative. Hit that thumbs up when you like the videos. You are supporting me, you're supporting the truth, and letting me know that you want more of this kind of in-depth detail. If you want the financial education you were not taught in school, these two books have everything that you need. You can get everything from the foundation, the history, the asset class, classes, making money so much more. Check them out at the link in the description if you want the audiobook that's available at themoneygps.com. Did you know that there are now 5,600 stores in the United States that are closing? Well, I break it all down in this video. Click on it and I will see you there.